Hello and welcome to another episode of Speaking of Real Estate. My name is Carlos. I'm the Level 4 Realtor, and it's good to be with you again. I have brought my guest, Mr. Ramos from Guild Mortgage, back on the scene with us. Carlos, how you doing, sir?
I am doing well. The Carlos and Carlos show.
Just once again, ready to
That's
inform
right.
the
That's
public.
right.
Ready. So, hey, let's get into the topics at hand. I still think that buyers that are still dealing with high interest rates who are trying to get into their next property are still struggling with the fact that uh, the the interest that they're paying is also like making their mortgage extremely high. So I know that there's a couple of other options out there for them, and I was just wanting to discuss the pros and cons of each one and how they work. So I know one of the options that buyers have is what they would call, or what you would call, paying down your points or paying down discount points. Can you briefly explain to us how does that work?
Yeah. So, like in our last video, we talked about buying buy downs. This is a buy down in a different way. This is where you do a permanent buy down with the money that you have available. So, say hypothetically the interest rates are 7% today, and you want to pay it down to buy it down to a certain rate. Now, each on the interest rate, so it's not as easy as going from 7 to 6. If you want a 6% interest rate with discount points, there's fees for each increment and the rates go by the eighths. So, like, for example, if it's 7%, the next rate below it is actually 6.875, and then 6.75, and then 6.625, 6.5. So it goes on and on, if you know what I mean. And for each level, there is a fee associated with that to get that lower rate. So if somebody had you probably would have to have a lot of money to go from 7 to 6, but maybe you can go from 7 to 6.5, and that's enough money, and that might give you the payment that you want to get into. So you have to understand it's just not easy to buy down a rate from 7 to 6, without a ton of money. But that's why we do buy downs, and we talked about that in our last video. So a discount point, origination fee, a lot of people call it so many different names. So it just really depends on how much money you want to spend to get the payment that you're looking to have.
So I was thinking hypothetically when it comes to buying down points. So, for example, let me just throw a scenario at you.
Yeah.
I need help with my down payment. So I'm going to ask you for a low entry FHA, the
hmm
usual 3.5%. But then I turn around and say, oh, well, I've got money to buy down the points. So is there some kind of trigger or switch that would forbid me from maybe doing something like that since I now have evidence of having more money? Or can I go ahead and do that? Because that sounds like something that could help a low entry buyer on both sides, the down payment and the interest. Could that work or no?
Yeah, yeah. There's no just because you have a little extra money doesn't mean. So if you want to do an FHA loan and you only want to put 3.5% down, there's nothing wrong with that. You can have 100,000 in the bank, and if you only need 3.5% down, it's okay. The lenders are not going to penalize you because you have more money in the bank. It's just really your choice on which product you want to go with. And of course, it's always comes down to the monthly payment. Everybody wants a low payment, and but you also have to understand having a low payment usually comes with the amount of money you put down. The more money you put down, the lower the payment. The less money you put down, the higher the payment and the higher the interest rate you're going to end up with.
Right. And I know if you're a low entry, you're pretty much probably you're gonna have to deal with the PMI, the mortgage insurance as well. So I guess then the next question is what would benefit my mortgage? And when I say benefit my mortgage, I mean lower it more. A bigger down payment or paying off the points?
A bigger down payment in the long run would probably be a better option. Here's the thing you have to understand when paying down points, it's really going to depend on how much you're going to be saving. So, for example, like I'll use the example I did earlier with 7%, 6.5%. If that difference is only going to save me, say, $50 a month, okay, but it's going to cost me $5,000 to save $50 a month. Let's do the math. Divide 5,000 into 50, $50 a month. How many months is that? So if it's going to take you more than 2 to 3 years to recoup your money, it's probably not a good idea to spend the money on points. You just wasted money. So you're
Oh,
probably better off
okay.
just spending that on your closing costs or put more money down for a down payment. Because I had a guy whose credit report had a $5,000 credit card with a $200 a month payment, and he wanted to spend 5,000 to spend $50 a month. So I advised him not to spend it for the $50 a month, but to actually pay off his credit card, and he would be saving $150 a month more if he did it that route. So we have to look at the whole story to see what's really going to be beneficial for the client.
Cool. That is very important. That's really good to know. It's good that there's that strategy behind how to make or how to help someone save a little more money, not just up front, but in the long run. So before we move on to the next one, I guess the last question I have is when someone wants to consider paying down the points, in your experience, is there a certain type of buyer or property type, like, a fixer upper, just as an example? Is there a certain type of buyer or property type that would benefit from that kind of option?
I mean, not really, but if I had to say a certain property type that usually the rates are a lot higher on, is condos and manufactured homes. Those two type of properties right now have the highest interest rates because when it comes to condos, a lot of people don't want to put a lot of money down. But condos are also a risky property, just like a manufactured home. So because they have a higher risk, the lenders have priced in their margins, the risk factors for that type of property versus a single family home or a townhome. So it does make a difference on the property type. You will most likely be paying just a slightly higher rate for a condo and a little bit higher on a manufactured home.
Okay. All right. So that is an option that buyers have out there who are trying to combat the high interest rates that many
Yeah.
buyers are facing right now.
Yep.
And so the other option, and I know this one is a little more familiar to me, even because a lot of us dealt with this one back in '08 as well. And it's
Hmm.
the adjustable rate mortgage, AKA the ARM.
Yeah.
I know the ARM tends to have a bit of a bad rep, but it can't be all bad. So first of all, let's get to the nuts and bolts of it. How does an ARM work?
Well, an ArmWorks is great program for somebody who's probably looking at short term. So we have a 30-year fixed loan, which is the most common type of loan that everybody takes. Then we have 15-year, 20-year, 25, but 30 years is pretty much the most common one. So now say you want to do a 5-year adjustable rate mortgage. So that means the interest rate for that 5 years is fixed just for the 5 years. Now, who's a great person that for this type of product? Somebody that's looking short term. Maybe they live in an area and move every 2 years or every 3 years. So sometimes the rates on an arm are slightly a little bit better than what a 30-year fixed is. So those are the people that will probably take something a loan like that. You have veterans that like the PCS, every time, or maybe not all the time consistently, but if some do know that they're going to be traveling or moving to a different base, maybe they want to do an arm. So it just really depends on the person. It's always the length of time they think they're going to be living in a home right now that's going to determine whether or not adjustable rate mortgage is actually beneficial for them. With the interest rates right now, arms interest rates and a 30-year fixed interest rate pretty close to each other. So it's just really going to be on that, me having that conversation with the client saying, how long do you plan on being here? We look at the adjustable rate mortgages, see if that's beneficial. Now, what happens if you go past the 5 years? Okay, so you're going to have an adjustment. Now, every 5 year arm is different. So let me just use this example. That maybe it's going to adjust 2% up or down based on the market at that time. So it's just really going to dictate on that. So most people that are in arms that are aware of it, they're usually refinancing or selling their homes before the 5 years is up.
I'm glad you brought that up because I do remember the amount of time and then the balloon is, I think, is what they call it after. So I guess a question, depending on the amount of years you set up the arm,
Hmm.
does that affect the percentage increase at the end of the term? So I guess hypothetically, if I asked you for a 3 year versus a 5 year, after the 3 year, would the increase in interest be smaller than after the 5 year, or is that still set? There used to be a limit. I don't know if that's changed. How does
They
that
do
work?
they do have limits on how high up or down it can go. It's just really going to depend on the product type. There's a multiple products, so it's kind of hard for me to give you the exact amount, but you can expect it to go up or down. A lot of people real think back in the old days of like 2008 and back 2012, the 228 arms, which were really, really bad back then, subprime loans.
Yeah.
The arms these days are not like that. They
Good.
are fixed. As penalties, are not like what they used to be. It's probably hardly any penalties out there right now for those type of products. It's just like it has to be a savvy buyer or explained correctly from a mortgage lender like myself, telling you exactly what's going to happen on year 4 or
So,
year 6.
okay. So briefly, then you touched on this, and I guess I just want to make sure the rules have changed somewhat for
Yeah.
arms since back in those days. Then
Oh,
they're
of course, of course.
good, good, good. I try to never think of or consider ever doing an arm again because of that experience. But
Yeah.
I'm glad institutions took it upon themselves to kind of realize how that worked the first time around, and the fact that they fixed it. Um, Last thing. Well, you kind of touched up on it. Basically, the arm is something you would probably recommend to someone who knows that they're going to be dealing with a property for a short amount of time.
Correct.
Now, uh, as a lender, even though let's say I tell you, hey, yeah, no, I'm just going to be there for 3, 4 years, going to fix it up and then do whatever. Can you look at numbers and look at someone and say, are you sure this looks like you might be there for a while? And then after this kicks in, you're going to be paying this much more. Has your experience shown you're almost like a card reader, a tarot reader when it comes to,
Yeah.
but have you gotten to that point where you can tell and then you can say, yeah, hey, I don't think you should go this route, even though you're telling me you're going to do this. From what I see here, this could be a problem for you real soon or in the future.
Yeah, I just think there's a big misconception of arms being really, really bad based on the past history of it. Arms are not like it used to be.
Okay.
The arms that got a lot of people in trouble, they're gone. So we don't have to worry about that. But yeah, I can look at somebody's history, talk to them about it, find out a little bit more of where they really plan on going. And plus, honestly, in today's market, I can actually compare the rates, take a look at them, and if they're like an eighth of a point of a difference, or maybe not, the arm may be a little bit higher than a 30-year fix, and I'm going to say, hey, look, we're going to go with the arm. I'm sorry, we're going to go with the 30-year fix versus an arm, and it might be a better option. Like I said, it's really only good for a lot of short-term people, people that move, very savvy with their money, and understand that that it has to be refinanced or um, paid up or sold or whatever in the 3 years, and they just know that that's going to happen. It's not a very not. It's like very savvy people. They understand it. The product with an arm. It's just not like it used to be. Everybody hear arm and they run and get scared. I don't want to do an arm, because of what happened in the past. It's totally different right now. Very
That's good.
secure
That's
loan.
good.
Yeah, so it's
That's
totally
good to know. That's good to know. So, all right, Carlos. Well, listen, I think we've covered two more options for buyers out there. Uh, there are ways to combat these high interest rates, and a specialist like Carlos will be more than happy to help you with that. And then once he's done helping you with that, I would be more than happy to help you find your next home. I am going to post our information in the description below. Please hit subscribe and like this video and help my channel. I'm going to try to provide more information for you every week. Until next time, thank you for spending some time with us. Take care.
Bye now.